Happy Monday. Hope you're doing well and had a wonderful weekend. I've got some great data to share with you today, and then we'll talk about interest rate movement, kind of where that's heading and where we've been the past week or so. But let's dive into some interesting data. So this is national at national scope, so it doesn't specifically focus in on the Boise metropolitan area. But just so you're aware of what's happening nationally, and it's reflective here, right? We're part of the nation, so it's reflective. We're seeing existing home sales. This was the March data that just came out. Closings on existing homes. Inventory nationally remained around 980,000 units for the third straight month in a row. Now, this is very low, right, compared to 2007 when there were 4 million units available. So if you have clients out there, they're saying they're waiting for the bottom to fall out because prices are going to drop dramatically this spring or summer. Boy, I think they're dreaming. I really do. I mean, when you're back in 2007, we had 4 million units. We had fewer households that had been formed at that time, a lower population base of potential home buyers than we do right now. And we're really low on inventory nationally. We're low here as well in the Boise area. This is still an area where I think we're gonna face more of an acute housing shortage than we have up to this point going forward as rates continue to drop and buyer demand picks up. It's going to be even more competition and more of a housing shortage than we have because it's such a desirable area for people to move to. So this is great data to show people, hey, this is not the great real estate recession we saw 15 years ago. This is a very different scenario, mostly because of lack of inventory and the fact that there are more households and more demand. So what does that mean? So if you look here, it says we're unchanged, right? We still have a 2.6 month supply of homes nationally. A normal market is about 4.5 months of supply. That means we're about 29 days in the market. That's down from 34 days in the market earlier this year. And 65% of homes sold in less than 30 days. That's up from 57% of homes selling in less than 30 days. So, yeah, nationally, there are some trends here that are still pointing to the fact that we have a solid market with plenty of demand. First-time home buyers, about the same, but 28% from 27% last month of all homes. Cash buyers are 27% to 20 compared to 28% the month before. And investors, 17%, kind of down a little bit from 18% from the last month. So about 1 in every 6 transactions on a national level, right, is investors. And we may have slightly more than that here, which speaks to, especially in the lower price points, which speaks to the fact that, hey, there's expected to be even more robust demand as we go into spring here and summer. So interesting information to share with clients that are sitting on the fence and not quite sure if they should move forward or not. Also, want to show you this. There's another leading economic indicator here for the potential of a recession coming soon. Okay. And this is from the Conference Board, Bureau of Economic Analysis. The blue line shows a year-over-year change, right, in economic activity. And it always leads ahead of the real GDP. So we get the gross domestic product numbers lagging. But this shows that when this drops, as you can see, every time it drops, the GDP follows, right? So it dropped back here, then the GDP follows and drops and shows a negative GDP. We are getting close to the point where the GDP is negative, which could indicate again, right? It happened last year. I'm sorry, it happened in 2020 in the pandemic, but we're getting close to where GDP could tip into negative territory, again, indicating a recession at some point here. Most economists are thinking third quarter, maybe fourth quarter this year for actual negative GDP growth. So wanted to show you that chart, just to let you know that there certainly are periods of time here that seem to be moving forward. When you see this drop hard and then start to rebound, always looking in the rearview mirror, then the economists say, oh, we were in a recession. We just got through it, right? So we may be in one now. We're just about to get in one, as you can see, as drops here, recession being the gray areas here, 07 to 09, and then right around the pandemic time. So we'll see what happens, but that's kind of what's happening there with some information on recessionary indicators and also housing and where that's at. So want to show you a cool tool that I have to share with you. If you don't have this, contact me, reach out to me, text or call or email me. This is a calculator just for realtors, just for you, to help you calculate down payment amounts, etc., sellers' concession amounts. So in this case, it's telling you this calculator. The first one is max seller credit. So what's the maximum seller credit that a seller can contribute towards buyers' closing costs and prepaid escrows? And this tells you that if you're on a conventional loan, 3 to 10% down, it's 3% of the sales price is the max. If it's 10 to 25% down payment, it's going to be 6% of the sales price. 25% down or more, 9% of the credit is available from the seller, okay, which is a lot. If you're FHA, 3.5% down or more, 6% of the sales price is your credit. VA, 4% credit. USDA RD, 6%. So in this example here, if you have a $450,000 purchase price, and you could plug in 6 or 3 or 4 or 2 or whatever credit you want to put in there, it'll calculate it for you. In this case, 6% is 27,000, which is plenty, right? It's more than enough. It's plenty it'd be hard to use that up, right? Even if you're doing a 2-1 buy down, which is fairly expensive, it'd be tough to use that up. But let's say you had a 2% seller credit. What is that? $9,000 would be what you're looking at as far as the seller credit amount. Or if it's maxing out at 3%, you plug that in there. So that's just a quick, easy calculator to help you out. And then this one, there's 2 calculators here, 2 pages. This is the date the rate buy down calculator, right? You've probably heard from a lot of lenders in the industry this winter that we should be focusing on dating the rate and marrying the house, right? That's kind of the current buzz phrase, if you will, which makes sense to some degree, right? We want, when people are buying a house, it's more permanent than an interest rate. It's much easier to refinance than to sell and move, right? So if they feel like they ended up with a high interest rate, they can always refinance it down the road. One tool that's out there to help people qualify a bit easier for a home, not qualify, but afford a home, at least for the first couple of years, is the 2-1 buy down. Now, I just did a reel on this like a week or 2 ago that I posted to my Instagram account. By the way, if you're not following that, please do. I think you'll find it mildly entertaining. Bill.z.mortgage. Great. I'm putting together some good reels out there that are informative and helpful that you can share with clients. But one of them I put together was about the 2-1 buy down. As you can tell in the reel, I'm like lukewarm on the idea. And then in the caption, I kind of trash the idea, right? A bit. Now, I will say that 2-1 buy downs make sense for some people. Those that have a job that has guaranteed increases in salary, they're going to be there for quite some time, and they know that the salary increase is going to compensate for the increase in rate on a 2-1 buy down during the first 3 years of their mortgage. Makes sense. Pretty much everyone else, or you're going to get a major inheritance, right? So you can afford it, whatever. Pretty much everyone else, it's tough to make the case that it's a good idea to do a 2-1 buy down. It's hard for me to make that strong case. And the reason for that is because you've got somebody who's going to be in an interest rate that's a teaser rate, right, for the first year. And then it's a little less of a teaser rate, but still a teaser rate for the second year. And then the third year, they get to their fixed rate for the last 28 years. Well, the challenge is that's a fairly significant jump in payment for most people. So they got to be really cognitive of what that's going to do and be very comfortable that the payment's going to be working well for their family budget. So I would go through the numbers carefully with people if they're considering a 2-1 buy down to make sure it's going to work. But if you are selling a 2-1 buy down, the only way to make it work is to have a seller, to make it make sense for a buyer, is to have the seller pay for the cost of the buy down for the buyer. Because the cost of the buy down, really what it is the savings, is the payment savings added together. So the payment savings during those first 2 years added up, that's the cost of the buy down. So why would you pay for your own payment savings, right? Doesn't make any sense. So a seller kicking in and paying for that does make sense. So here's the calculator and how that works. So let's say somebody bought a $600,000 house, they had 3.5% down payment, for example. And I just threw a round number here. This is not reflective of what rates are today on a specific scenario. But let's say it was a 6% rate on an FHA loan. Your first year rate would be 4%, second year would be 5%, and then years 3 through 30 would be 6% fixed, unless you refinance down the road when rates come lower. So what does that mean? Well, the difference is the subsidy is this. The difference between the third year rate and the first year rate. Subtract those two times 12, that's your number. Subtract this one and this one times 12, that's your number. That's how much you're saving, right, for that year. And you add those 2 years together, and this is your total credit. That can be paid for by a seller plus normal closing costs and prepaid escrows. So this calculator allows you to change things in yellow, right? So if you have a 5% down payment instead of 3.5%, you're doing conventional, you could change it. If you know your rate's 6.5 instead of 6, you can change it and adjust all the numbers for you. So you know what that 2-1 buy down cost is. And then I would, as a lender, talk to you about, okay, what's the additional normal closing costs, right? And what's that going to be on top of that? So you know what the seller credit is going to be total. So another calculator just to help you out. Let me know if you'd like a version of this. I'll send this to you so you can use it on your own. I can do the calculations for you as well, or double check your calculations and make sure you did it right. But just want to give you another tool that's helpful to you as we're in a kind of unprecedented times here in the market. Okay, let's take a look at the charts real quick. So what's happening here in the market, in the mortgage-backed security market? We're actually seeing a slight improvement today in mortgage-backed security prices. UMBS is up 13 basis points. The 10-year Treasury is down 6. That's good. They're inversely correlated. Excuse me, I can't speak this morning. So if the UMBS is up in price and the yield on the Treasury is down, that means we're getting an improvement in rates slightly. So as you can see down here, we've seen an improvement over the past 5 days or so. This here, last week, we kind of had a tough week. There was some Fed speak. The Federal Reserve is made up of a number of governors that are in different regions of the country. And a few of those were talking tough still. So that hurt the bond market. It kind of made it like, oh, crap, when is the rate hike's going to end? Most economists are hopeful that there may be another 0.25% hike in June, and then that might be it for the year, right? Nobody's betting on the Fed dropping or lowering rates at this point. But if we dip into a recession, they may, right? Sometime later this year or early next year. So at any rate, comments like that didn't help. But the market is regaining its footing. We do have a pretty tough customer with 3 overhead resistance lines here. We have a Fibonacci level. We have a 200-day moving average. We have a 25-day moving average. And we have a 50-day moving. We got all the moving averages causing, well, except for the 50-day that's below us, causing a ceiling of resistance to get through, right? So it's going to take some good news to do that over the next few weeks. We anticipate good news on the inflation front. So let's see if that helps improve interest rates. But for now, we're going to be bumping up against this ceiling, probably not doing a whole lot, kind of staying in this range. However, you never know, right? So if you're looking at buying, if you have a client who's going to buy, who's going to close in the next 30 days or less, it's never a bad idea to lock so they can sleep well at night. But call me if you have any questions about the markets, about the calculator. I'm happy to get a copy of that in your hands. In the meantime, have a wonderful day and a fantastic week, and we'll talk to you soon.